Hey, good afternoon, everybody. Welcome to today's event. It's the Q4 earnings sneak preview. Today is Monday, January 16th. You got John Hopkins here. Tom Bowley going to jump in just a minute. If you're new to EarningsBeats, really want to welcome you to tonight's event. I think you're going to find it very informative as we get ready to head into the earnings season in earnest this week and next. Of course, all of our events are recorded. For some reason you're not able to be here for the entire event, don't worry about it. You will get a copy of the recording sometime later tonight. We've also got our tomorrow night will be our members only Options Max Pain webinar, one of my favorite webinars of the month, where we talk about imbalances of puts and calls as we get ready to head to the monthly options expiration on Friday. So we got our ETF webinar coming up, which is also members only, then our Q4 earnings next week. So just a boatload of stuff. It's a great time to be a trial member or a member of EarningsBeats. Anyways, we're going to jump right into this thing. I want to see if Mr. Bowley's on board. How's it going, Tom?
Hey, John. I'm good. How's everybody doing? You good?
Yeah, not too bad. Kind of a lazy Monday. Market closed, for the holiday, which is nice. A 3-day week. Had a great finish to last week, and I don't know, maybe things will be a little promising in the very near term.
Well, we're going to find out because we got some big overhead resistance coming up in terms of trend line resistance, a couple key levels around the 4,100 level on the S&P. So, yeah, we're going to have our work cut out for us. But good news is so far, January is off to a great start. And January is a very good historical barometer for the balance of the year. So where we are right now, we're only halfway through the month. But if the end of the month finishes right where we are right now, it would put us in the top 25% of all Januaries since 1950.
Mm-hmm.
And that historically bodes very, very well for the balance of the year. So we'll see how we finish out the month, and of course, see if we can take out some of the key resistance. If we do, I think the bulls certainly will have the upper hand at that point, but still got some work to do this week.
All right. So I know we want to get this thing going. I'm going to turn it over to you.
All right. Sounds good. So first of all, welcome everybody. I know if you're getting this by recording, we did have some issues getting emails out yesterday. The service we use on our EB Digest was not working. So that's the reason why you didn't get an invite, and you may be listening to this recording, but we should have that fixed in the future. We certainly apologize for any inconvenience, but I think you'll get the information you need here. It's going to be a fairly quick webinar, I think, relative to some of our webinars. I'll try to make this one pretty brief. This is really just a precursor, if you will, to next week's earnings webinar. Next week, we will be looking at probably over 100 companies and pointing out companies that look really good going into their earnings reports and those that don't look quite so good. But let's go ahead and talk about what we're going to do tonight. So let's go with that agenda. We'll start off with the earnings beats that we have seen so far in 2023. I know we're only a couple weeks in, haven't seen a lot of reports, but we do have some companies that have reported, and I think, I don't know, maybe close to 10 of them, or maybe right around 10. Really good looking reports that I would keep on watch list. You get some of these stocks on pullbacks. They could be some great trades coming up. Got a few stocks that did not report very well. So talk about those earnings misses. Then we'll get into the 2022 Q3 earnings analysis. If you want to have some idea of what we'll be doing next week for our members, since this is a public event, the one we do for members is much more in depth. We do actual study, and I'll show you that spreadsheet that we kept from last quarter, detailing, what this analysis does and the odds. I think it really improves your odds in terms of determining whether or not a particular stock is going to report good results or bad results. And I'll go over that with you all in just a little bit. And then we'll wrap up with just taking a look at the week ahead. So we've got a number of earnings coming out in the week ahead. Of course, probably things really pick up the week after that. But next week, there'll be a number. And I don't know, I'll probably have another 15, 20 charts that we'll look at there, and then we'll wrap this thing up. So let's first start with the 2023 earnings beats. And the first company, let me pull your charts up for you, but the first company that I wanted to go through was, or is, Richardson Electronics, RELL. All right, you should have your charts up now on your screen. What I look for is companies that are performing really well relative to their peers, their industry peers. Because if you think about it, the big Wall Street firms are able to go in during the quarter until the quarter ends, and you go into a quiet period. But prior to the quarter ending, these big Wall Street firms can go in, find out how companies are performing, how they're doing relative to their competition and within their industry group, and are they on track to meet their forecast, maybe even beat their forecasts. And so after gathering all this information, they go back to their offices and they decide, okay, let's buy these, let's sell these. And the way we can see it, we can't be in on the meetings, but the way we can see it is how these companies perform on a relative basis. Obviously, if the big firms are selling, we're going to see a downtrend, relative downtrend. If the firms are buying, we're going to see a relative uptrend. So RELL, you can see, had been trending up through most of the year, but especially into the last quarter. We had a big surge back in October, held up pretty good, pulled back a little bit as we consolidated. RELL, though, actually reported really good numbers, beat on the top line, bottom line 39 cents versus 29 cents, so really big beat. We gapped up and sold off initially. And sometimes you get these, buy on rumor, sell on news type of events. But look what happened after the sell-off. We went down below $18. 3 days later, we were up over 23. So I think this is a stock, maybe it consolidates, maybe it goes a little sideways, but right now I think it's a pretty good performer. And I wouldn't be surprised to see the stock go back up and challenge the top around 27. Next stock, AEHR. This is Air Test Systems. Another stock that on a relative basis, you can see relative to the to the semiconductors, performing really well through the end of November. And then the stock just kind of went through a little profit-taking period. Of course, when it does that, it's going to lose some relative strength. But then the earnings came out, and you can see what happened here. Big move up on heavy volume. AEHR beat on the top line, more than doubled earnings on the bottom line. Expectation was 7 cents. They came in with 16 cents. So Air Test Systems, big response to earnings, doing very well there. CAG, this is Conagra Brands. I think you can see steady uptrend. Look at the AD line, strong. Relative strength right into the beginning of the year, setting new highs. Company beat top line, beat on bottom line, 81 cents versus 66 cents. Gapped up, continues to perform really well. I think CAG looks good. All right, Lamb Weston, LW. Again, you can see that AD line strong. Relative strength has been going up almost all year. Went through this period here where we went mostly sideways. When you consolidate, a lot of times you'll lose a little bit of relative strength, but heading into earnings started to pick back up again. Solid earnings report, gaps up. I think LW looks good here. CMC, this might be my favorite stock so far in terms of reporting. AD line, great. Relative strength been strong. This is in the steel group. Steel has been a great performer relative to the S&P 500. And then earnings came out. We actually gapped up initially, pulled back there for a day or so, and then took right back off again. We pulled back right to the breakout level and then took off. So CMC, easy beat top line, easy beat on the bottom line, 224 versus $1.99, and the stock looks good. SNX, TD Synex Corp. Since October, since that low, really strengthening here. You can see the AD line setting new highs off that October low as well. And look at the relative strength. Actually started back in September. Very, very strong. We found out why when they came out with their earnings. They beat by, looks like about 500 million on revenue. Bottom line, expecting 292. They reported 344. Very strong on SNX there. Next up, BlackRock, BLK. Nice move up here, little cup, nice consolidation. Look at the relative strength pickup when we started moving up off that October low. Nice relative strength. It's continued higher. Stock came out with earnings on the 13th, so last week. Didn't really do much with its earnings, but the numbers were fantastic. 4.34 billion in revenue versus 4.16 estimate. And on the bottom line, $8.93 versus $7.99. So really good report for BlackRock. And I think it's showing on the chart. We want to get this breakout above 775, but I like this cup. Would not be surprised to see a nice breakout coming up soon on BLK. Then we've got Delta. So Delta Airlines. Airlines really on fire to start this year. But you can see Delta, big move up. It actually reported its earnings and gapped down, but it was more because of a buy on rumor, sell on news kind of thing than anything else. You can see that hollow candle after gapping down. Lots of buyers came back in. They beat easily on the top line and also beat easily on the bottom line, $1.48 versus $1.29. So Delta looked pretty good there. And then the last one I have for you is JP Morgan. Another great report out of JP Morgan. Look at the AD line strong. Look at that relative strength. It absolutely exploded in the last quarter. And then JP Morgan reports both revenue and earnings ahead of estimates. Earnings, $3.57 was the actual. Estimate, $3.11. So a 46-cent beat. That was about 15% above estimate. Stock gap down. So again, it was one of these buy on rumor, sell on the news. And then, of course, right after the open, lots of buying on JPM. So those are companies that have reported so far. I know we're early into earnings season. Really, technically, I always go by Friday as being the start of earnings season when JP Morgan and some of the other big banks start reporting. But there were other companies that have reported since the beginning of the year, and I wanted to share those with you. Now, which ones have not reported very well? Well, we'll start off with a restaurant company, Kura Sushi. You can see price action's been going down for quite a while. Look at the restaurants. Restaurants been going up. So KRUS on a relative basis has been going down, and we found out why. They missed on their revenues, 39.3 million versus 39.9 million. And then they also missed on their earnings. They were expected to lose 16 cents. They actually lost 21 cents. So again, relative strength. Wall Street knew what was coming. They're getting out. This is how we can tell. Relative strength. At least we don't want to take any chances, any major chances. And look what the stock did. Came out with its earnings gap down. It's worked its way back up, but I have a feeling it's going to roll back over again. I don't like the trend line that it's about to test. Also that 50-day moving average. The next one, and you probably heard a bunch about this stock, Bed Bath & Beyond. It's one of the most heavily shorted stocks. Came out with its earnings on January 10th. The revenues came in 1.26 billion, way short of the 1.43 billion that was expected. And bottom line, they were expected to lose $2.36. They lost $3.65. And that was on the 10th. Now, I think it's one of those sell on the rumor, and then we got a buy on the news, which then triggered a short squeeze. But I don't know, with all the news that's been coming out, and after looking at that report, I don't know who in their right mind would try to buy this stock at $5, except if you're trying to ride a short squeeze. But I don't know. I mean, you can see how ugly this last short squeeze ended back in August. We don't know how far it's going to go. Maybe it goes back up and breaks out again, but this is one you got to be really careful. If you're playing it on the long side, you making money, probably want to think about taking profits off the table, at least partial profits. The third one and final one I wanted to show you so far this year, KB Homes. And when you look, the home builders have actually been doing really well. You can see home construction index, very strong. And relative to the S&P 500, home construction bottomed all the way back in April of last year and has been going up ever since, starting to accelerate to the upsides. That sound like, a problem with inflation and higher interest rates coming down the road? I wouldn't think home construction would be doing that well. So I think the market is pricing in rate cuts ahead, and the fact that we will top and we'll be seeing lower interest rates. I think we already have topped on the 10-year Treasury yield. But look at KB Homes relative to its home building peers. It set a low, a relative strength low in September, and it's just been going sideways. It really has not shown much strength at all. It is trending above the 20-day, but I think that it's kind of like a rising tide lifting all boats. So home construction's been so strong that it's even lifting stocks like KBH. But this one has been a laggard relative to other home builders. If you want a home builder or home construction stocks, there are going to be plenty of others to choose from. I don't think KBH is the one, not based on the way it's trading right now. So I'd be a little careful on that one. But those are three reports that have been out so far this year I thought were rather bad and stocks that I would personally stay away from. All right, the third of our four topics for tonight, I wanted to go over the earnings event spreadsheet from Q3. This is what we did last quarter. So let me bring up this spreadsheet for a second. And just show you. Now, I was giving you, kind of the relative strength look on the charts that, had reported really good numbers. And you could see it's not just a one-time event. These stocks are being accumulated many times before they actually report. And the same goes for the ones that didn't report well. You're seeing a lot of distribution on their charts, at least on a relative basis. KB Homes was trending up, but it was not a good performer relative to other home construction companies. So when I'm looking at these charts and I look ahead and I try to figure out, okay, what companies might report really strong numbers and which ones might miss, I'm using relative strength a lot in my analysis. I think it is the key earnings indicator more than anything else. If you're holding a company and you look at their relative strength, and they're getting ready to report earnings and you see that relative strength line going straight down, I would be very nervous holding, because it's just telling me that Wall Street has no interest whatsoever in the stock, and they know a lot more than we do. So you want to pay attention to what's going on. Now, what I did in our Q3 earnings last quarter, the one for our members, the one that'll be coming up next week, what I did is I looked ahead at 125 companies, and I broke them down between 68 companies that I thought looked pretty good going into their earnings. And then down below, I listed the negative, and I had 57 of those. So 68 positive, 57 negative. And the purpose of this was to see how they reported, how they reacted to those reports. Because you can have a great company, a great earnings report, and still gap down. We saw that last week. Delta Airlines, perfect example. JP Morgan, both came out with stellar results and the stocks gapped down at the open. But if they're strong stocks and they report great numbers and they gap down, they're going to probably become a pretty good opportunity on the way down, whether they're hitting their 20-day, maybe it's a price support, maybe it's a trend line support, probably something going on that we're going to like there. So looking back, and just go over with you what happened last quarter, of these 68 companies, you'll see the earnings. I basically looked at the next week, and there were a ton of companies coming out. So I went through and looked for a lot, but from 10/24 to 10/28, this was the date of their earnings. And if you look at the negatives, same thing, 10/24 to 10/28. I looked at the week ahead and said, of all the companies, these are the ones I like. These are the ones I don't like. Now, if you look at the ones I like in green, you will see if they beat the estimate for revenue. You'll see they'll be in green if they beat their estimate for earnings per share. If they matched, you'll see black. And if they missed, you'll see red. Now, I just want you to take a look at this and just eyeball this to see how many beat versus missed. I mean, most of them beat. 57 beat, 10 missed, and there were 68. So there was one. I think I never could find the revenue results. I may have deleted it from the spreadsheet. But even of the 67, 57 of them beat on revenues. 54 of the 67 beat on bottom line. 11 missed and 2 matched. Pretty strong. I mean, not 100%, but you got pretty good odds of coming up with some good numbers, just simply based on these. All of these charts were not given at the end of the week. These were given out at the beginning of the week before the earnings results came in. Pretty strong results. If you look at the misses, look at all the red down here, the ones that just look negative in terms of relative strength. Look at all the red, much more. 27 beat, 29 missed on revenues. Earnings, 37 beat, 16 missed, and 4 matched estimates. That's quite the disparity from what we saw on the beats or on the positive charts versus the negative charts. Now, when I went back through and I looked at reactions, because over here on the right side, this was the earnings reaction date. So it would be the next day. So you had your close right before earnings. This was the open after earnings were reported. And then this was the close the day of earnings. And then I did a 1 week later close and 2 weeks later close. And then looked at the opening gap. So what did the stock do when it first gapped from the prior close? So you can see this one fell $2, which is 1.25%. And then what was the close at the end of the day? 5.5%. So right here, you can see the difference between the prior close and the close after earnings. So all of these were checked and came down, and I had an average. The next day, the average reaction was up 1.13% over 67 companies. And of the 57 that missed, their average the next day was up 0.25. So basically, the 67 or 68 that I gave on the positive side outperformed the 57 that I gave out as negative by almost a full percentage point. That's the average. And I also went back and looked to see, okay, which ones went down more than 10%? And when I looked at them, there were 10 across all the stocks. Let's see, there were a couple up here. Here was one down 18%. Here was one 17%. Actually, here was 29. Here was 11. So there were 4 that went down more than 10%. And if you look over here, you had 1, 2, 3, for, well, there were only 4 of those under 10%. Maybe it was the gaps. At one point I was looking. I'm just kind of flipping through, looking at these as I go down. And what I didn't do is calculate how many of the 57 went up and how many went down. But you can see here, this was the 1-day gap. So the average of the gap, the opening bell, the 57 negative average dropping about 0.2%. And on the ones that were positive, the average gap was up about 0.6%. So it was about an 0.8% swing between up and down. I think going through this many companies and having that kind of difference at the opening gap, again, this just giving you better odds. If you have relative strength winners going into earnings, I think you have a much better chance of getting a better reaction and also reporting better results. What I like to see is any of the companies on this list that are positive, if they beat top and bottom line and then sold off that next day, those types of stocks would be ones I'd be interested in, looking for them to hit major support levels, whether it be a 50-day, 20-day, price support, trend line support, something. But this, we're going to actually do this again next Monday. I'm going to give a list like this out of positive and negatives for the following week. And I'm going to give you a little bit of a sample of it tonight because I'm going to look ahead to just for the next few days. Not a lot of earnings are coming out, but I want to go ahead and go through those with you. So let me pull this back and let's look at the charts again. So this will be the 2023. This is going to be the week ahead that we're going to be looking at. So coming up tomorrow, there were 5 that I kind of liked and 2 that I didn't. Or actually, no, there were 5 I liked and I didn't see any that I didn't like. So everything else was just kind of neutral. Let me go through the ones I liked for tomorrow and we'll see how they come out. Goldman Sachs, AD line breaking out to a new high, starting to put in these higher highs, higher lows, which I like. Relative strength, right toward the middle end of November, we were setting a new 52-week high relative to, excuse me, the investment services group. And you can see, really, we've just been going through a sideways consolidation. It's actually like a bullish continuation pattern. Move up, that's your uptrend. This looks like a cup to me. Maybe left shoulder, neckline, head. If we fail with earnings and pull back, maybe down to the 20-day, that would establish to me an inverse right shoulder. So if we were to gap down with its earnings tomorrow back into the 350s, somebody who's aggressive might want to think about picking it up on the long side, because I wouldn't be surprised if it gaps down and then comes right back up. So I would be looking either for that gap down and move back to the right shoulder, or if it does gap up, it could just finish what looks like maybe as a cup back up to the 385, 387 area. IBKR. So this is in the bank, or actually this is also in investment services, but a really nice move a few months ago in terms of relative strength. And we got up here and then we just started going sideways a little bit, strengthening again. But as we were going sideways, that's when we lost a little bit of relative strength. I wouldn't be surprised to see a big number here in a gap up with IBKR. CFG. So this is Citizens Financial Group. AD line setting, I don't know, 10-month high. Relative strength's been picking up for the last 3 or 4 months. So this is one that I'm mildly interested in. UAL, really strong. You can see January, big move up. It's just been a monster, closing on highs every day with big volume, which has just sent its AD line straight up. And looking at the relative strength, I mean, it's 52-week high relative to its airline peers. So I'm expecting a big number out of UAL. ERGS, Progress Software, I'm seeing a cup. AD line breaking out. Relative strength been moving up now for the last 5-6 months versus software. So I would expect that this is going to come out, PRGS will come out with a decent report. Moving on to Wednesday. I like Schwab. AD line, still pretty good. We've been trending higher here. Look at relative strength. Just set a new 52-week high at the end of December. Pulled back a little bit. Hammer, I think the stock's going to move back up and set a new high. FUL, this is HB Fuller. Another one, big move up. Pulled back, but now starting to turn back up again on the pullback. Lost a little bit of a relative strength there, but it set a new 52-week high a month ago. I wouldn't be surprised to see the gap up with earnings, maybe head back up toward that 80, 81 area. Now, one that doesn't look so good to me, reporting on Wednesday, is JB Hunt Transport. AD line, not bad. Haven't been able, we got to get through 195. But what looks bad to me is this relative strength line going down near a 52-week low. Don't want to see that right before earnings. So I got some reservations here. I wouldn't feel very good about holding JB Hunt into earnings. On Thursday, Procter & Gamble, I think, looks pretty good. AD line's been on a roll. Price action's been up. Once we got to this level, you can see the relative strength kind of tail off here a little bit. But that was off of a huge move, and we've been consolidating. I think with the, I wouldn't be surprised to see a gap up and clear 155 with earnings this week. Netflix, AD line breaking out the new highs. Look at the relative strength on Netflix. Tell you what, if Netflix doesn't report good numbers, all of internet might be in trouble, because this is one of the strongest internet stocks heading into earnings. I think we could see a big gap up on Netflix this week. Again, that'll be on Thursday. TAL, this is Tao Education Group, AD line strong. Look at the move up. Look at the volume coming in. Since we hit that high, we've seen the relative strength pull back a little bit, but I wouldn't be surprised to see really strong numbers. If we pull back, if we do have great numbers and the stock sells off, I'd love to see it get back down close to that 50-day moving average. Now, there are several stocks I don't like on Thursday. The first is Fastenal. AD line looks good, but look at the relative weakness on this stock versus the industrial suppliers. It's been going down for months. Look at the volume trends, big selling there. Looks like distribution. We're getting a little bit of a bounce. I'm not going to be surprised if we get a gap down, maybe a miss. MTB, one of the banks I'm not really feeling very good about. You can see these keep coming up with these big gap downs. So we go sideways, we gap beneath it, we work our way back up to the top, and then we gap back down again. Then after going down a little bit, we work our way back toward the top. I don't know. We'll see what happens with MTB, but I don't like it. You can see the relative strength's been horrible for the last 3 or 4 months. Just not liking MTB. All right. Next, FITB. Another bank. AD line, okay. Still trading down here in this trading range off of a downtrend. It really needs something positive to get the stock going. Near its 52-week relative low versus banks. I don't know. There are a lot of other banks out there I like better than FITB right now. And SIVB, another one in this space. You can see the gap down here. Went right back up to the bottom of gap resistance. I don't know. It just looks like maybe it could be set for another big drop. Not really showing, even after the huge relative drop, not able to really get much back. I don't know. I just don't like to look at it here. CMA, a few months ago, would have loved this bank. Going back into September, look at the relative strength. But September and October, it just fell apart. and it's down at a 52-week low right now. I mean, why isn't it following the rest of the banks higher? Why is it performing so poorly? Probably going to find out on Thursday. And then on Friday, just got three more for you, and we're going to wrap up. First one is SLB. I really like Schlumberger. Big move up, sideways consolidation, breaking out. AD line looks great, relative strength. I would like to see if there's one little minor flaw here is that we've broken out and relative strength is just going sideways here. I'd like to see the leadership take back over again, but this is one that really was strong in terms of relative strength and then took off, sideways consolidated, and has broken out again. So I like the stock, and I think maybe it starts to show much more leadership if the numbers are as good as I think they might be on Friday. Huntington Bank shares. This is a bank I like. AD line really starting to soar here last month or so. Beautiful move back up. And on a relative basis, after a huge move up, it's actually just been consolidating here sideways. I think with earnings, it could get going again. I wouldn't be surprised to see it back up, testing that 1550 area. One that I don't like from Friday, and this is the last stock I have for you. This is Ericsson. AD line's just choppy. Stock's been moving down, lots of gap downs, not really performing very well. And look at the relative weakness relative to the telecom equipment group. Now at a 52-week low. If you're in telecom equipment and you're looking for a catalyst to take you higher, I don't know that ERIC is going to be the one. It just doesn't look very good to me on the chart right now. Anyway, that's what I had. I said it would be a fairly quick one. We only went about maybe 30, 35 minutes, but I'll be happy to take any questions if there are any questions, John.
Yeah, I was going back and forth with somebody. We were talking about Netflix and any other stocks. Number one, pointing out to people that what we're looking at tonight, looking at Max Payne earnings, there's no guarantee for anything. We're just talking about indicators. It's very possible, Netflix can make a run and then we get towards Max Payne and it pulls back.
Yeah.
Because it's there's too many puts. There's just all kinds of things that can happen. But I know personally, Tom, when it comes to earnings, this is just me personally. What I like to do is I like to see, I don't hold stocks, and it's very rare that I would hold a stock into an earnings report because there's been too many times I've tried that in the past, and it literally is a crapshoot. It can go either way, and it's fantastic if you hit it, but it is really painful if you don't. So I like to wait for a stock to report, see if it gaps up to a key resistance level or pulls back to a key support level, then make a decision, with everything else if I want to get involved in a stock. But I just tend to be really careful when it comes to earnings because, like you pointed out, when you were talking before, even if a company has strong earnings, it doesn't mean that it's not going to pull back, or maybe the earnings are weak and it could, take off. So I just think for me personally, I think it's a bit risky.
Yeah, I think with Netflix, the one thing I would say, if earnings is the week of Max Payne, I would ignore Max Payne. I would just ignore it. It might come into play next week, but the thing is, if it gaps up, there's going to be so much volume in the stock market makers won't be able to control. They're not going to have enough capital. Netflix is wildly traded. It's very heavy volume stock. If they come out and they beat their numbers and they raise their subscription forecast going forward, I would not want to try to short that stock into Max Payne. I don't care. I mean, maybe I'm wrong. Maybe it gaps up and then it comes crashing back down. If it did, I certainly would be in it on the way back down. But to me, that one's very risky. That you might as well just go right up to a craps table or the roulette wheel and put your money on the table, because that one, it's going to be hard to manage your risk in a stock like that. But
yeah,
I like the way Netflix looks. I'll be really surprised if Netflix lays an egg with its earnings report on Thursday. I think we're going to see a blowout number by Netflix.
Yeah, and the other thing is, like I was looking at UAL, for example, which has been a monster, and they got earnings come out. They're very overbought, at the moment, can stay overbought. But I know in the spreadsheet Aaron put out this weekend, it was showing that, they could pull back because of Max Payne potentially. So same thing. You could get a report, it gaps up nice, then Max Payne takes over. This is going to be an interesting week for some of these stocks that both have earnings and could come into play with Max Payne.
Yeah, I mean, if you're going to play around with Max Payne with earnings stocks, I just wish you luck. I hope it works out. I normally would try to stay away from it, but if you really like the volatility and you like the big moves, if you get it right, you can make a lot of money. Just remember what happens if you get it wrong.
That's the painful part. I know we're not getting into individual stocks, and I don't even know if they're reporting. Somebody was asking about HEI. Is that even anything that shows up on the radar here?
HEI, well, first I'll see when it reports. It reports February 23rd, so you still got a ways to go.
Okay. All right.
Looking at the chart on HEI. I mean, it looks nice. I see a move up in an ascending triangle, equal highs, rising lows. I like the pattern here. AD line looks good. It's in the very, very hot aerospace group. And notice it was a leader until it went through this period of consolidation. So yeah, I love the way this HEI looks. I think this one looks great.
Somebody just started making a question/comment. Do you think with the good financial earnings, which will hopefully carry through the rest of the market, S&P up against resistance, your Max Payne calculation, we may have enough power to break through this resistance?
I don't know. I mean, the market can do anything it wants to do. Max Payne is one indicator, and that's an indicator that would suggest maybe we go back, we pull back. Keep in mind though, and I say this all the time, we'll talk about it more tomorrow with the Max Payne event that we do. But Max Payne isn't just the week of options expiration. It can also go into the following week. And, one big question always comes up is how can that happen if options expire on Friday? Why would it go into the following week? But if, let's say Netflix, for instance, gaps way up, anybody that's got in the money calls right now, if Netflix were to gap up $40, $50, $80, whatever, they would have a ton of in the money call premium. They may want to just exercise and own the stock. You can do that if you have an option. That's what it gives you the right to buy the stock at your strike price. So let's say on Netflix, and I'll pull the chart up, but let's say you have a call on Netflix right now for 300, and on Thursday it gaps up to 375. You're $75 in the money. If you sell your option, it becomes a taxable event. You obviously have a big gain. But if you move into the stock, if you actually exercise and you have the cash to move into the stock, the cost of the option becomes part of the cost of the transaction of the stock. There's no taxable event, and you can then hold the stock going forward. Well, think about what that does to the market maker. Instead of them being on the short side of that call contract, now they're just simply on the short side of the stock. So anybody who exercises an option that's in the money, if it's a call option, they go long the stock, they're still subject to the manipulation of market makers the following week if they still own the stock. So that's why you can get a little bit of Max Payne effect into the following week. And I think it's one of the big reasons why the worst day of the calendar month is the Monday after options expiration, monthly options expiration. And so I think we're going to want to be careful beginning part of next week if we have a solid week again this week.
All right. Just two more and we'll wrap up here. The question was, did you do the same calculation 2 weeks later? I think he was talking about the spreadsheet, when last month when you looked at where stocks were. I think he's asking, I don't know exactly what he's asking, but I think he was asking, did you look at any stocks beyond what you were showing on the spreadsheet in terms of how they performed?
I had a column for the 2 weeks later, which I had filled out, but I didn't do a calculation to see how maybe I'll have that ready for when we do the event next Monday, so that
Okay.
We'll have the history of that for next week.
Let's end on this one. Ford's reporting February 2nd, still a few weeks away, but any thoughts on Ford?
Well, autos in general are just horrible. Tesla obviously is the big one that's pulling everyone down. You got Rivian, you got Lucid, some of the others. And we did get a bounce in January, but if you just look at the group, I mean, on Ford, look at autos. Again, heavily influenced by Tesla. but you got autos going down. You got autos relative to the S&P 500. This is the worst industry group by far over the last 3 months. Nothing is even close to it. It is horrible. So I'm not expecting, now you can see Ford relative to the autos looking pretty good. So is this going to be the one that maybe is spared? Maybe. I think it's still pretty risky just because the group has been so poor. Even if Ford comes out with good numbers, if the overall group doesn't begin to strengthen, I'm not sure how far Ford can go with a weak group overall. So I don't like Ford right now, even though it is showing leadership relative to some of the other really beaten down auto companies.
All right, Tom, I think that wraps it up.
All right. I appreciate everybody coming in. We kept this one pretty short today, but the one next week will be longer. I'll have a lot of stocks for you. Again, that one is a members only event. So John mentioned earlier that we have a lot of events coming up. It's unbelievable. I mean, my head's spinning trying to get ready for all of them. But yeah, we got a lot of stuff coming up. So if you want to take out a 30-day trial, this is a great time to do it because we do have so many events coming up that you'll be able to be part of, even as a trial member. And it'll give you a pretty good understanding of our service and what we do for our members. But that's it. Hopefully see everybody tomorrow night for the Max Payne event. I'll be looking at a number of companies where we might see them go based on their net in the money call and put premium that's out there right now. But that's it for me. So everybody have a great evening, and we'll see everybody tomorrow, hopefully. Happy trading.